Welcome to today's market report. European stock markets are seen opening marginally lower on Friday, ending the week on a cautious note amid political uncertainty. DAX futures traded 0.2% lower, CAC 40 dropped 0.2%, FTSE 100 fell 0.2%. Tensions remain high between the EU and the UK, with the two sides locked in a standoff over how to implement the Brexit deal in Northern Ireland, despite more than 3 hours of talks between top officials on Thursday. Britain has been seeking changes to the Northern Ireland protocol of the deal after checks were imposed on goods moving across the Irish Sea from Great Britain. Members of Italy's Five-Star Movement voted on Thursday to back Prime Minister-designate Mario Draghi, opening the way for the former European Central Bank chief to take office at the head of a broad government of national unity. UK GDP grew 1% in the fourth quarter, double what analysts expected, averting the immediate prospect of another pandemic-induced recession. However, this still meant the UK economy contracted 9.9% last year, the largest fall on record, hurt by the lockdowns associated with the COVID pandemic. The banking sector will remain in focus after Dutch bank ING released fourth quarter data, following on from rivals Credit Agricole, UniCredit and Commerzbank on Thursday. The cosmetics sector will also be in the spotlight after L'Oreal beat consensus with a 4.8% rise in currency-adjusted sales in the quarter, albeit the performance was entirely dependent on strength in China. Oil prices slipped lower on Friday, weighed by the more cautious tone taken by a couple of influential industrial bodies on the subject of demand recovery from the pandemic this year. US crude futures traded 0.8% lower at $57.75 per barrel. Brent contract fell 0.7% to $60.70 per barrel. Gold futures fell 0.4% to $1,819.50 per ounce. On the FX front, GBP/USD has been declining as US yields are on the rise. Quarterly GDP for the UK grew 1% versus the 0.5% expected, and the cable has responded with a buy the rumour, sell the fact. The pair is now ready to rally to new highs, shrugging off the encouraging GDP figures. Nevertheless, it remains well positioned to rally. House Democrats continue drafting the bill in the background without new details, potentially about agreeing for a more generous stimulus. Bonds will likely remain bid. In turn, that implies lower yields and pressure on the greenback. Some resistance awaits at 138.20, which supported cable when it traded on higher ground earlier in the day. It is followed by 138.65, the fresh 2021 peak. Further above, 139 and 140 await the cable. Support awaits at 137.85, the daily low, followed by 137.50, which was a stubborn cap earlier in January. Further down, 136.80 and 136.15 await pound-dollar bears. The euro-dollar strength is expected to be capped for now at its 55-day average and price resistance at 121.46 to 121.90 for the unfolding of a sideways range, in the view of FX analysts. Support remains at 121.13 to 121.08 initially, below which is needed to see a minor top complete to add weight to our near-term ranging roadmap for a retreat back to 120.88 with 120.46 to 120.19, then ideally holding further weakness. By mid-year, we are able to disperse first funds to power Europe's recovery, Ursula von der Leyen, President of European Commission, said in a press conference following the signing of the Recovery and Resilience Facility. EU countries need to ratify their own resources decision and present solid national plans, then funds will start flowing under #NextGenerationEU to power Europe's recovery. The US dollar edged higher on Friday, but still heading for its first weekly loss in three as doubts emerge about the strength of the US economic recovery. The dollar index was up 0.1% at 90.487, but still on track to fall 0.6% this week. Dollar yen was up 0.2% at 104.88. Aussie dollar rose 0.1% to 0.7746. The weekly initial jobless claims data came in weaker than expected on Thursday, adding to last week's non-farm payrolls number that suggested the recovery in the jobs market in the US would be a prolonged affair. This is today's market news. Thanks for listening. We'll see you next time.